Well, good afternoon, ladies and gentlemen, and welcome to this second webinar that we're having. It's good afternoon to you guys who are here in the auditorium at the JSC in Sandton. It's good afternoon to all those in South Africa who are linked in, so good afternoon to you. And a good morning to David Lehman. David, can you hear me?
Yes, I can. Good morning, or good afternoon, I should say.
Well, David, it's great to have you. And David is online direct, as you can hear, from Chicago. It's 7 o'clock, I believe, David, in Chicago?
That's correct. 7 a.m., nice, sunny, kind of warm morning here.
Okay, well, we've got, as usual, pretty sunny weather here. And so thank you very much for getting up early to help us out on what, according to the slide, which you might see, is a complex problem. Not so much a complex, but the soybean complex. Now, one thing that, let me just introduce it by saying, if you wondered where the A went, those of you who don't know, we often talk about soya and soybean in South Africa. In the States, they talk about soy and they drop the A. So that's why the A is missing, because we talk about the CBOT contract, and that is a soybean or a soybean complex, which, as you know, we're now trading on the JSE. So the program for this afternoon is really quite simple. A few words from myself. My name is Rod Blondin. And I'm fortunate to head up a great team of guys who put things like this together, and on what was the agricultural market, but now, as you know, moved into additional commodities. Right after my 5-minute introduction, we're going to go straight over to Chicago, to David, who has been involved in this type of business for a long time, is a great fellow, and I'm sure you're going to enjoy what he has to share with us. Straight after that, Chris Sturgis, who I think you all know. Chris will talk about the actual contract, the operation thereof on our market. And then Wesley Martins from Absa Capital, one of our invaluable market makers, will talk about the function of market making and the risks associated with it. We will have questions, and it says Q&A. I certainly hope we'll also have answers, but we'll have questions. Let me just run through that. For you guys here in the auditorium, please use a mic which will be available so that people around who are dialing in or linked in, and also for David, will be able to pick up that question. And then for those guys who are linked in by the computer, and we would encourage you to ask questions, you're welcome to type your question in and it will be relayed to us and we'll be able to answer that question. So, just a very, very brief introduction. We started talking to the Chicago Board of Trade some time back. It was actually before 2007. I think it started when I had the good fortune to sit next to Bob Ray at a dinner in Bucharest in Romania. And we looked each other in the eye and we said, can't we do something together? At that stage, it didn't look like it, but we're very happy now that through the cooperation we've had with the South African Reserve Bank and the ability to list foreign reference commodities, we then introduced, as I think all of you know, the corn contract. And we're very, very happy with how the corn contract is trading, January 2009. And basically what we have in place is a licensing agreement with what is now the CME Group, because as you know, there was a merger in the States. The CME Group now the largest derivative market in the world, and we have a licensing agreement with them which allows us to close our contracts off, keep the contracts honest using the Chicago price. And I'm sure Wesley is going to discuss, or Chris will discuss exactly how we use those prices and the South African exchange rate to the dollar to work that out. And as you see in the last point there, currently we have the CBOT corn, the soybean complex, which is the topic of this afternoon's webinar, crude oil, which we dealt with earlier, platinum, and a COMEX gold listed product. And pretty shortly, we also believe we will have additional commodities as well. So we're looking forward to that. So, right over to David. David, we have a picture. I don't know whether you can see that, but for those of you who've been fortunate enough to get to Chicago, we have a picture of your building, and it's over to you. Thank you very much once again for joining us.
Well, thank you, Rod, and it's my pleasure to join your seminar this morning. I'm going to run through a few slides. I've got about 15 slides here that describe the soybean complex at CBOT. And when I say complex, it's including soybeans, soybean meal, and soybean oil, the two products that these three futures are often traded as a combination, or as we call it here in the U.S., the crush. So I'll start out by going to slide number 2, which is our soybean futures volume and open interest. And for whatever reason, this the scale on the horizontal axis for this chart is off by a couple of years. When it was copied over from the Excel sheet, we were finding occasionally this happens, but the dates should actually be Jan 08 through May 10, and that's actually through the end of June of 2010. So this is pretty much right up to date. We don't have our July volume data in the chart yet, but what you see is both volume and open interest for the soybean futures contract. It's monthly volume, so the bars represent volume, and they're measured by the left-hand axis. So you can see we're trading about 3 million soybean futures contracts per month on average. Obviously, some months less than that, some more, which equates to around 150,000 contracts per day. And the line, then, lighter blue line on the chart is the open interest or open positions in soybean futures as measured by the right-hand axis. And you can see that fluctuates a pretty good decline from Jan of 08 through about Jan of 09, I believe, is when we sort of hit a low, and that coincided with the global credit crisis and all things becoming correlated, if you will, where liquidity was declining in a lot of markets. But we've recovered, retraced some of that back up to just under 500,000 contracts in open interest. Slide number 3 is the nearby soybean prices and a 30-day moving average of those prices. So this gives you some idea, and again, this is the same time period as the previous volume slide of volume and open interest. And you can see quite a bit of volatility in soybean prices, certainly in the first half of this slide, especially from Jan 08 through Jan 09. We moved from about $12 per bushel to 16-something, I believe 16.70 something was the high in mid-08, and then down in the $8 range in early 09, and now kind of volatility declining a little bit in the market, and as you see in 2010, we've been in a little narrower trading range. That has that's begun to change a little bit lately, and if we had a little more current data in the slide, you would see we've been on a bit of a rally. Our nearby price is at 10.67 right now on the August contract, and volatility has picked up a little bit in most of the grains. I'll turn to that slide next. Slide 4 shows the volatility, and this is a historical volatility, so it's not implied from the options, but it's calculated based on a 20-day average, moving average volatility from futures prices. So we calculate this every month. We post it on our website. We have a table on our website that goes back to 1980 with this data, so you can get a good idea of kind of what the average is. And I think the long-term average is around 20 to 25%. You can see in that 09 time frame when the market was really declining sharply from the previous slide, that volatility peaked up at about 75%. And so this is the annualized volatility. So what these numbers represent is what based on the previous 20 days of price movements, what the expected movement would be over the coming year. So 75% higher, 75% lower is what the market was forecasting as a range in mid-09. So as you can see, there was a lot of uncertainty at that point, and now we're back more at the kind of long-term historical mean for volatility of 25%. Slide 5 is just a snapshot, or not snapshot, but a little history of the global soybean market, and this is a metric that our traders look at quite a bit, what the projected ending stocks are versus the annual use of a commodity, and then they calculate what we call a stocks-to-use ratio. And so what this chart shows are ending stocks in the dark blue bars for the last 10, 11 years, going back to the 2000-2001 crop year, and that's measured on the left-hand scale in metric tons. And then the lighter blue line is the ratio of ending stocks to total use for that crop year. So this is something that the market looks at globally to, get a feel for how tight our supply situation is relative to use. And as you can see, global stocks have been generally growing over this time period from about 35 million tons in 2000, 2001, pretty much double that, up to 70 million tons. So we've had a very pretty good situation in terms of trend line for stocks growing, while consumption has been very strong as well, primarily attributed to China's continuing increase in exports or imports of beans from both the U.S. and South American destinations. So we're right now in the 2010-11 projected stocks, and this data is from USDA, from their World Agricultural Supply and Demand Estimates reports. So obviously 10-11 represents the crop that will be harvested this fall, and the projected stocks remaining at the end of the crop year in August of 2011 for the U.S., and then the corresponding levels in primarily Brazil and Argentina as the other two main producers. Chart 6 then actually shows our entire complex, the average daily volume. So the previous chart 2, was monthly volume. As I mentioned, about 3 million contracts a month in soybeans and about 150,000 per day in soybean volume. Chart 6 shows the complex average daily volume. So the dark blue portion of the chart on the bottom is the soybean volume, and you can see it, poking above 150 at times to close to 200,000 a day, but somewhere in that 100 to 150,000 contracts a day range over this time period, which goes back a little earlier to August of 2007 through July of this year. And then on top of that, the next lighter shade of blue is soybean oil volume, and that contract has really grown in volume in the last few years as it's become important in the energy markets as well as the food markets, soybean oil being a key feedstock into biodiesel production. So oil has been trading 80 to 100,000 contracts a day, and then soybean meal, the lightest blue colored portion of the chart on top, and soybean meal trades in the probably 60,000 contract per day range. So we showed a world stocks to use ratio in chart 5. Chart 7 shows really where those stocks come from and also where they're held. So in terms of world production, we know that the U.S. and Brazil and Argentina combined account for the majority of world production. China is included in this chart as well, but the U.S. is the dark blue section on the bottom of the chart. Around 85 million tons is kind of a standard or expected level of production in the U.S., depending on yields and a little bit on acreage shifting. And that's been an important factor in the market in the last few years is acreage shifting into corn to meet the demands for ethanol in the U.S., also competing with soybean acreage for soybean oil to support biodiesel production, but also and more predominantly in bean oil to meet the growing incomes and growing demand as a result of higher incomes and better diets around the world. So the U.S. is, you can see, is kind of fixed in terms of its acreage. We don't have a lot of acreage that can come into production, so this number has stayed pretty flat over the last 10 years. Brazil is the second largest producer, and their production has grown a little more so than the U.S. in this time period, and then Argentina being the third primary producer. Argentina producing now about 50 million tons, Brazil getting close to 70 million tons. So certainly together, Brazil and Argentina produce more soybeans than the U.S., and as I'm sure everyone knows, Argentina is the leading supplier of products then to the world market of soybean meal and soybean oil. Just to look at world exports of soybeans, again, U.S. still the leading exporter as an individual country, and you can see we're exporting somewhere.
And I guess we're still on the webinar, so everyone out there is going to listen to a bit of humor while we just wait for Dave to connect. As we often tell a story when we're chatting to farmers about the farmer who comes to Joburg, and please, if you've heard this a number of times, just humor me and try and laugh. About the farmer who comes to Joburg, and as a farmer, always nervous about city traffic. You know, you hit Kaluli's interchange, and there's this panic. You know, hold on to that steering wheel. Anyway, and the farmer's in the city, and he's about to walk across the road, and he hears this, and he just, whoa, big voice behind him says, stop. And as he stops, this big bus comes flying past him. He says, whoa, I don't really like the city. But anyway, a couple of weeks later, being a farmer, likes outdoors, you know, good Natal country, he's in the Drakensberg, busy hiking, and all of a sudden the mist steps in, and he hears this voice again that says, stop. And as the mist clears, this huge gorge was about to step in. Wow, very happy about that. But anyway, a few weeks later, this time of the year, he's busy harvesting like anything, and a call comes across the radio, combine harvester broken down quickly. We need you at the field. Anyway, he jumps out, gets into his pickup truck, or his bakkie, as South Africans like to call it, and is about to reverse back, and he hears this voice that says, stop. He stops, gets out, and he checks his favorite dog behind the wheel, and he's very happy about that, but he feels something strange in his pocket. He pulls it out, and then I guess you won't be able to see this on the webinar, but there's a small little green man in his hand. He says, hey, who are you? He says, hey, I'm the guy I just told you to stop. He said, are you the same guy who told me to stop when I was in the city? Yeah. And recently when I was hiking? Yeah, I'm the same guy. Where the hell were you before I got married? So we try and say it back to say we all wish we had a little green man who just gives you that guidance to say when to buy or sell on the markets. So yeah, if you've heard that, we've used that joke copious quantities in the past, but always proves the point. Are we there, Dave? Unfortunately, Dave couldn't hear that. What we can do in the meanwhile, but it's actually very good if we can just continue, but we're going to move on. Okay. So guys, bear with us as we skip a few slides. You would not to take any of let's just do that. Do that. I'll get there now. Page down. We'll just flick through these. You can see everything that was about to come through. What we're going to do now, while we just reconnect Dave there, is chat about the local contract specs if you haven't actually had time to look at them, and try reference them back to what we're trading here in South Africa. As Rod had introduced the product, it's really subject to the licensing agreement from CME, or Chicago Board of Trade, that we're able to list and provide these products to the South African investor. And the complex, which Dave will get to a bit later, and Wesley will also refer to, consists of the bean contract, the meal, and the oil. So whenever you see any codes, these are really JSC codes for our trading system. It's important to note that that is then the local Chicago bean contract, the meal contract, and the oils contract. It's just 4 characters that we required, and for 2 of them worked very well. Well, the third one's there. The contract expiry months, really tracking US expiry months. We try to piggyback and mirror them with the local soybean contract. So you'll find that March, May, July, September works well for all of them. And then we have the one anomaly where November is an expiry month on beans, but certainly not for meals and oil. So we have that December. And perhaps a question for Dave a bit later, why that scenario exists. The contract size, you'll also see Dave will work through their standards. We've converted it back to metric tons. So we have 100 tons on both the bean and the meal contract, and then 25 tons for the oil contract. Very important, all quoted and traded and matched in South African rands. So it's not the US price. Wesley will bring in the exchange rate component. Everything is going to be matched and settled in rand, which keeps the Reserve Bank happy because that's part of our approval process. Minimum tick size is there, 20 cents, and you can see this was from the oil. Definitely no barrels of soybeans trading here. That should be bushels. Or in sense, the tons. Settlement method is going to be in rands, and then last trading date, I've got a slide a bit in more detail that I'll cover that process. Again, to give everyone peace of mind, you're never going to be able to take physical delivery of the underlying commodity. You're always going to be cash settled. And again, giving Reserve Bank peace of mind that market makers can actively quote your price here and then also be able to get out of the position without any risk of taking physical delivery. Trading hours at this stage, 9 to 12, so in line with the other grain products. That does present some challenges if the liquidity picks up on these products, because we're obviously referencing a very early Chicago trading period. And then admin periods, as everyone is aware. The big thing around to take note of is the initial margin requirements. How do we get the initial margin requirements is we've obviously worked very closely with our clearing members, and there we're trying to manage price movement. Really a risk of an excessive movement over any single day. And what we do is we take 7 years of trading data, bring in the currency volatility as well as the US price, and at the end of the day, try and cover for a 1.5 day maximum movement. So you'll notice there's no price limits on these products, unlike white maize and wheat. These obviously have price limits in the US, so there is some management there. But the initial margin is saying, if we include the currency component and the Chicago dollar price of beans, what has been the maximum movement over the last 7 years? And let's kind of cover for a 1.5 day worst scenario. With that model in place, at the moment it changes monthly, so we'll update the initial margin each month. And on beans, it's 21,000 Rand per contract. If you took our local soybean contract, which has price limits, yes, it is slightly more. I think that works out at 15,000 Rand. So there is obviously a slight premium as far as initial margin goes, remembering we're referencing the international bean market plus having the currency volatility built in there. If you were to start trading calendar spreads, obviously your initial margin comes down substantially to 6,000 Rand per leg. On the meal contract, it's 19,000 Rand per contract, 190 Rand a ton. The calendar spread being 5,400, and then on the oil contract, it is obviously a lot higher. If you look at the value of that product, trading at 11,000 Rand is the initial margin requirement. We also offer series spread, and you'll see as the discussion evolves around the complex and how do you build that up. If you long one product, short the other, will require 3,500 Rand per product. So you need to be long and short to be able to get that series spread offset. Daily mark to market is then done on trading activity on the local contract. Dave, you back?
Yeah, I'm back on, Ron.
It's Chris here. Rod had to step out.
Oh, hi, Chris.
Welcome back.
Thank you.
You were fortunate enough to miss some of my humor as I was trying to tell some of the standard jokes. So we've quickly flicked. We've quickly just working through the local contracts. But what I'm going to do is actually go back to your presentation.
Okay.
And we can kick it off. Average. There we go. So we're good to go again on your side. Welcome back.
All right. Well, if what I'm saying is a little too boring for the audience, maybe that's why the line dropped. I don't know.
I can guarantee you no one's left the auditorium yet. I'm not too sure about the online audience, but we're still all sitting here.
Okay. All right. Great. Well, I understand we were just at the export slide, which is slide 8, and this is showing world soybean exports. As the slide shows, the lower section blue is the U.S., and U.S. is still the leading exporter from an individual country perspective. Brazil is then the next section on the chart, lighter blue, and Argentina the gray section. So we see that Argentina and Brazil together are larger exporter to the world market now than the U.S., but for an individual country, U.S. is still the largest. And this shows pretty impressive growth over the last 10 years from about 100, a little over 100 million tons to over 160 million tons in total world exports. Soybean oil exports are shown in chart 9, and here we see a little different story. Same time period, last 10 years, but U.S. and Brazil are the kind of smaller exporters for soybean oil, and Argentina is the primary exporter. And I mentioned that earlier. Argentina tends to keep the beans in the country via a VAT tax on soybean exports and encourages processing into meal and oil and then exporting the products. So Argentina is the primary supplier of oil to the world market. And the same is true with soybean meal for the obvious reason that Argentina, again, placing a tax on soybean exports, that encourages or incentivizes crushing in the country and exporting the processed products. So Argentina, again, the primary supplier of meal to the world market. Slide 11 is an interesting slide. It's a slide of the Commitments of Traders report, which you may follow there. It's from our regulator, the Commodity Futures Trading Commission, and this is actually called the Supplemental Commodity Index Trader Report, which CFTC began publishing in January of 2006 or January of 2007. They included 1 year of historical data when that first report was published. So the data goes back to Jan of 06. and it's right up through the latest report that we had in July. And this data shows the open interest in futures and options combined for soybeans, and this report's done for about 12 agricultural or commodity markets in the U.S. And it breaks that open interest down by the primary type of trader. Non-reportables, meaning they hold positions lower than the reporting level, which in soybeans futures, I believe, is 150 contracts. And then non-commercials, the gray line on top, commercial hedgers and index traders, the passive long participants that are kind of new in the markets, but certainly growing in importance. And then the total open interest is the red dashed line. So as you can see, the total OI moves around quite a bit. You can see that decline from Jan 08 to Jan 09, and then a working back to a little over 600,000 contracts today. That's measured on the right-hand side of the chart. All the other lines, the shares of the four categories are measured on the axis on the left-hand side in percentage terms. So index traders represent about 15 to 20%, non-reportables in that same area, and then commercials and non-commercials represent between 35 and 40% of the open interest. So it's I think useful information to drill into the data behind this chart. Traders really look at, are the funds long or are they short in a market, and then try to surmise what that might mean depending on how the fundamentals may be changing as we move forward. Slide 12 is a slide of the salient features of each of the three components of the soybean complex, the soybean futures contract, oil futures, and meal futures. And I'll maybe skip over that slide. It's all pretty self-explanatory. Trading hours, the trading times of the delivery mechanism, the symbols for the floor, as well as Globex. And I guess I did forget to mention in the volume charts, the majority of the volume in each of these products, in soybeans, meal, and oil, is conducted on Globex every day on the electronic platform. Soybeans especially are up around 90%, oil a little less, maybe in the 70 to 80% range, and meal, similar to oil, are done on Globex on the electronic platform every day. The last couple of slides go through the crush spread, and I think this is something that it sounds like is of interest to the marketplace in South Africa. It's certainly a very active market here in the U.S., and so the crush, we've got a couple of products that are set up to provide a way for the trade to trade the crush. One, on Globex, you can now trade the crush in 50,000 bushel units electronically on Globex. So there's a crush market. You can buy and sell the crush at a price differential on Globex, and the actual trades into the legs, the beans, meal, and oil, are done using implied functionality, kind of the auto legger, if you will, of our matching engine. And then you can also trade an option on the crush on the trading floor. And so the crush option has been available for, I think, about 3 years. I think in 2007 we set that up on the floor. And so those are a couple of tools that we've provided to the market to help them manage their board crush or their crush margins via board crush. So what slides 13 and 14 do is just kind of walk through how that product is defined. And so crush is obviously the relationship between soybean futures and the sum of the respective meal and oil futures. And so what we do is convert meal and oil into cents per bushel using these conversion factors of 0.022 for meal and 0.11 for soybean oil. Those factors reflect the fact that there are about 44 pounds of 48% meal from a bushel of soybeans, and then the amount of soybean oil that is produced from a typical bushel of soybeans. So we convert those prices into cents per bushel and subtract soybean futures price and get the board crush. And that crush is typically somewhere between 60 and 80 cents per bushel, most likely. And so what soybean crushers do, who are actually buying soybeans and selling meal and oil, is they can put on the crush to lock in a margin, and they do that by selling the crush, which seems a little counterintuitive perhaps, but selling the crush is selling meal and oil futures, selling 11 meal, 9 oil, and then buying 10 soybean futures. And as I said, this is a trade that you can do at a price differential. You can enter bids and offers to buy or sell the crush on Goldex at the differential between these three different products. Then the reverse of obviously selling the crush is to buy it or to take the crush off by buying meal and oil futures and selling soybean futures. So this is set up, as I said, in Goldex in a 50,000 bushel unit, or 10 beans versus 9 oil and 11 meal. But you can also leg the crush in other quantities. You can do a one lot if you want. But the 10 beans, 11 meal, and 9 oil come closest to actually representing the contract sizes for each of those products. So I'll stop there. That's the end of my prepared slides anyway, and I look forward to answering any questions.
Thanks very much, Dave. Appreciate that. I think let's hand over to those players in the auditorium first. If I could just ask that you got any questions, we can speak into the mic so that everyone can hear, and then we'll move over to the webinar if there are any questions. Open to the floor. Dave, I don't see any hands jumping up at this stage. Maybe just a technical question around your expiry months. Interesting to note that you have a November expiry on the bean contract, but and no December, and then you have a December on the meal and oil. I'm sure there's a very logical explanation for that. Do you mind sharing that?
Well, I'd be happy to kind of give you my thoughts. The November is the new crop month for soybeans, and that's a very actively traded month. It really represents the crop that in our current crop year will be harvested beginning in late September, early October, and completed by November. The products, then it's assumed it takes about 30 days to get beans, say, or to get beans into the crush pipeline and crush them, and so the December meal and oil contracts are really the new crop meal and oil. Now, others will say, no, well, October is new crop meal and oil, but that's, I believe, the kind of the basis for the different contract months between beans, meal, and oil as these products were developed. Now, I can't really vouch for that. The bean contract was launched in 1936, and meal and oil in the 50s, in 51, 52. Obviously, a little before my time, but that's kind of the justification or the logic that we understand is that lag, if you will, from the time the new crop beans are available until they're actually available to crushers at their plants. And so the crush spread is nice and kind of tidy until you get to the October, November, December time frame, and there we match up October meal and oil with November beans, and December meal and oil also match up with November beans in terms of the crush spread. So that's a little bit can be a little bit confusing to the market, I guess. But that's the way the market trades them.
Dave, just to understand that matching up on the crush, and I guess we're getting quite technical here, is if you've got if you're trading the crush on December, you'll get November beans. Is that correct?
Yes, that's correct.
Okay, great.
You'll get, and so the crush, if you're trading the November crush or the December crush is, and actually I'm looking at the option now, the December option is November beans and December meal and December oil. And then there would be the January, we get back to same months, January beans, January meal, and January oil. So in December, we have December products against November beans, and in October, we have October products against November beans. So we have 2 months of the spread that use the same soybean leg, but different meal and oil legs.
Okay, that's certainly, I got that. Thank you, Dave. Certainly interesting going back to the 1930s on that contract spec, also slightly before my time. We've got a question here in the auditorium for you.
Hi, Dave. I just quickly think on your data. I just want to find out, sorry, it's Christo. I'm from the Marketing Council here in South Africa. Just quickly think on your data. Is it nominal data or did you deflate it?
Oh, in terms of prices, are you referring to chart 3?
Yes. Yes.
Yeah, that's nominal data. There's no deflation of that data. So what we show on chart 3 were Jan 08 through July of 2010. Those were actual prices in U.S. dollars for soybeans over that time period.
Great. I might catch you off guard. Just a quick question on carry costs. I know that came up in the last webinar on the beans. What is the typical carry cost these days?
Well, the soybean futures contract has a specified storage rate or premium charge in the contract, and that's the charge that a taker of delivery pays to the seller or the maker of delivery to compensate him for. It's not really storage in the current contract design because you deliver a shipping certificate and the beans don't have to be in store for that delivery to be made, but it's a call on the loading capacity really of the issuing warehouseman or shipper, and so that's 5.1 cents per bushel per month, or 16.51 of a cent per bushel per day. So we're right now looking at the August SEP spread. We have a big inversion in the market. Well, relatively good size. We're about a 37-cent inverse. So the market's not paying any carry today, but financial full carry in soybeans would be, say, for the SEP NOV spread, 2-month spread, and that's a typical spread would be, 2 times that 5.1 cents, so it would be 10.2 cents, and then whatever the interest rate that the market is using. In wheat, as you know, we've got a variable storage rate mechanism now in that contract in wheat. For financial full carry, we use LIBOR, 3-month LIBOR plus 200 basis points, and that's, I guess, somewhere around a little under 3%. So the interest on $10 beans for 2 months would be, that would be about 6 cents, I guess. So we'd have a financial full carry of about 16 cents per bushel. My math might be wrong on that interest rate calculation, but it's just the sum of the storage rate, and the storage rate in soybeans is fixed at 5.1 cents per bushel per month, and if we use a 3 cent or 3% interest, that's about 5 cents per bushel for the 2-month spread in interest. So financial full carry somewhere around 16 cents in a 2-month spread.
Great. Thank you very much, Dave. I don't see any more questions. Yeah, some traders may be seeing an opportunity there. None on the webinar? I've got a no out there. Thank you very much, Dave. You're welcome to stay online. Otherwise, if there's any other questions at the end, we can always just pop them through to you. Your choice.
Okay.
Thank you once again. Much appreciated.
My pleasure. I'll just go on mute and listen. Thanks.
Great. Thank you. Getting back to the South African contract specs, so certainly haven't advanced to be able to give you the crush in a single execution. You're going to need to leg that if you're interested in that at this point in time. But yeah, so 100 tons, we've converted that back to metric tons for both the bean and the meal, and then you've got 25 tons on the oil contract. Initial margin requirements, we've indicated we give you offsets if you long one product, short the other. And then, yeah, we do have options and available options on the future. We have really just mirroring the Chicago Board of Trade expiry dates as far as options go. We have, if you're interested in participating, there's certainly some option writers. They're going to be looking at hedging out those futures, and that comes back to what Wesley's going to be talking on again, and the quoting by the market maker. That's our fee there, 15 Rand on the futures, 10 Rand on the options. Qualifying audience, very important, the same as any of these foreign reference commodities. As individuals, foreigners, and corporates, you have unlimited access, whereas pension funds, long-term insurance companies, subject to their 20% of their foreign allocation limits, and then asset managers and collective investment schemes subject to 30% of their limits. So these really, the qualifying audience, fall in line with the currency derivatives that we have introduced, IDX, international derivatives, all standard, and that's guidance from the Reserve Bank. And then trade types accommodated. We obviously encourage and really ensure that everything goes through the central order book. So unless there's certain trade types that you can report to the exchange, since we're trading at this point in time only 3 hours a day, if you wanted to do a large structured trade, especially for those interested in that cross trade, and if the market maker can rather price it during a more liquid trading session in Chicago, we would then be able to book it or report it into the exchange. The minimum there is 50 contracts, as long as we're informed by 7:30 the next morning. Naturally, you do the trade amongst yourselves, between yourself and the market maker. Market maker obviously needs to be comfortable with you that you're going to honor your position when we report it into the system the next day. So some type of relationship needs to exist there, but we're happy to facilitate those type of transactions. To just really cement the delivery process, or really the lack of physical delivery, and how we cash settle all the products. Lot easier or transparent than the crude oil market, where crude oil obviously expires a number of business days before the actual expiry month with a December 2010 meal contract as the example, very easy, 2 business days before we go into the delivery month, the contract will stop trading in South Africa. So December 2010 on the 29th of November, on Monday 29th at 12 o'clock, if you still have a position there, that will be cash settled. Okay, so if you're interested in rolling that exposure or unwinding, you need to do it before 12 o'clock on the 29th of November. What we do thereafter is go into a cash settlement methodology referencing Chicago. And that's crucial for us because that's where we get the final price, which is obviously we're choosing a liquid trading session in Chicago, open to no abuse from South African participants. So as a market maker, they've obviously hedged on that side. They would need to replicate the settlement process. If you're a position holder in South Africa and you have a position, rest assured, we're going to use this methodology, and therefore there's no player in South Africa that can influence this settlement price. On the 30th of November, there will be no trading, although the contract will remain on the system. And on the 1st of December, you'll see a clearance date, okay? And that's when we simply close all remaining positions. You get your final profit and loss. Your final mark-to-market will take place on the 30th of November. Why? Because the afternoon or early evening of the 20th of November, South African time, we determine the settlement price. We put that into the files, the end-of-day run, on the 30th. And then on the 1st, you get your initial margin return. If we look at the iterations, it all depends if we're on summer or winter time in the US. South African summer, we take 30 iterations on the rand dollar. So every minute we'll be taking an iteration from the spot market, spot currency market, and then we also take 30 iterations on the meal. The same applies to beans or oil. So as a market maker, you need to replicate this process to make sure you unwind exactly at the same cash settlement price. A risk that obviously comes through in the double that they're quoting. Just to understand, what makes it slightly more exciting is we're obviously going to get a Chicago price in short tons, which we need to then convert back to metric tons. In beans, it's bushels to metric tons, and in pounds to... So there's a conversion factor. I know, Wesley, your presentation will cover those. So we've got the dollar price per short ton, the rand dollar average over 30 iterations. We multiply all that together, and we get the final settlement price per metric ton. And that then is the cash adjustment if you have a position. Those of you that's been through the core and expiry and still had a position, you'd be same process, familiar with that. So if you're interested in more information, commodities at JSE is the web email address. The web address also gets you to the page where you can then find the contract specs. There is a trading calendar on the web that then, if you going to get confused when the contract stops trading, reference that trading calendar with also the latest initial margin requirements. Any questions? I've got Benjamin, we need that mic quickly. We're getting value for money out of Benjamin today. Right at the back there. Andrew.
Hi, Chris. I'd like you to possibly go through how the mark-to-market's calculated on these new contracts, especially now that I think the liquidity might be a little bit low until possibly next season. So I know there's not a lot of volume going through, and there's not, I'm not too sure on the mark-to-market process.
Yeah. Not to overcomplicate things, we're really applying the same mark-to-market methodology as the other grain products. So we rely on the market maker to be quoting a double, and we'd look at that double compared to the last traded price. Now, naturally, if we don't have too much volume, we'll be just adjusting it to middle of the double or either best bid, best offer from what the market maker is quoting. So it's crucial that we obviously have data. We have market maker on screen because that's then relaying back the South African price for that specific expiry. We do reserve the right, if there are no prices, to go back and just do that calculation ourselves. If we see that clearly we're out of line from a market making perspective. So it's just referencing information on the screen. Naturally, if the contract was very liquid and in the last 30 minutes we were trading more than 100 contracts, that's a volume-weighted average price that we would use for mark-to-market purposes. So in line with the existing grain products. Krista?
Chris, the reason for no limits on the contract?
Yeah, we've sat around and when, corn was a good learning curve for us as well, because there's limits in the US market, but we have obviously exchange rate fluctuations that can come through any time. We didn't want to limit this side and then have to try and play catch up to whatever the US market's doing. So really, that's why the initial margin calculations, that 21,000 Rand per contract, that already brings in the volatility in the two markets. So we just need to be flexible enough to keep intact with whatever our currency is doing and whatever Chicago is trading. So we appreciate there is a limit on that side. Will ultimately govern how much we would move here. Otherwise, you find you're having a mismatch. South Africa would go to 1 point because we have a fixed Rand limit, but Chicago has gone a lot further than that limit, or the exchange rate has resulted in a bigger move. And therefore, certainly don't want to inhibit trading here. We just want to be able to reflect the underlying price, the underlying market. Any more questions? Christopher.
Thank you. Chris, just a question about the after-hours trading. Was that a maximum of 100 contracts or a minimum of 100 contracts?
Yeah, it was actually middle of that, a minimum of 50. It's strange how we get to the anomalies. Really, from a surveillance point of view, we just want to make sure that we're not booking 1 or 2 lots all the time. So it's a minimum of 50 contracts that we will then facilitate. We do have one exception to that, and that's given to option traders. So anyone who is trading options and they can confirm to us that they're using the international market for their delta hedge, we will then book any amount of contracts.
Do you not think a couple of us blokes are going to be busy between 9 and 12 on other commodities, and there probably might be a need for smaller volumes to be hedged after hours?
It's a new product. I think we're open to suggestions. If we see that 50 is really just the hurdle is too high, come and talk to us. Again, the important thing is the market maker's typically going to be on the other side of that trade, needs to be comfortable with you as their exposure, because they've got you as overnight risk until we book that transaction the next morning. But yeah, I think as an exchange, nothing's set in stone. It's really the original benchmark, and if you find that is just too high, we need to touch base with our surveillance guys, and then let's discuss another number. It's not certainly set in stone.
Thank you.
It's a good question, especially if I think you bring a typical crush trade to us. I think we need to look at that in its entirety and say, fine, there's a whole combination. Let's perhaps add, all 3 legs, as long as they get to 50. Also, the market maker needs to be comfortable with that size trade. I know Wesley's going to be chatting about, because naturally, and Rand Merchant Bank will also have indicated and confirmed they'll quote you a price. They're just not quoting on screen. But happy to also give you a price as a market maker. They obviously have resources sitting on the desk, and they're not only waiting for your call on the soya products. They're also doing other business, so they need to be able to manage that. Any more questions before we cross over to... let's just go through this quickly. Excuse me here while we get to, Wesley, your slides. And this is normally quite easy, Benjamin. Let's just try that. And there's a hyperlink. Beautiful. Yeah, Wesley, certainly head of the commodities desk, associate principal at APSA Capital. We've asked Wesley just to come across and give us a bit more background from a market maker's perspective. At this stage, as Rod had indicated, invaluable. We need market makers to be able to quote on screen. He'll give you some underlying reasons for the spread that they're quoting. We have other banks, we also not quoting on screen, but would assist if you were interested in that trade. But thank you very much, Wesley, for your time. Over to you.
Thanks, Chris. Thanks for the opportunity to talk about how we set up the pricing on SAFEX. So it's basically just going through the bid-offer pricing that we show on a daily basis on the soybean complex, and just sort of a brief summary of what we're going to go through there. So essentially, the three major components of that price that you see on the screen, be it the bid or the offer, is what's happening on Chicago, what's happening on the Rand, and then the forward points that are associated with that Rand. So just to sort of a brief summary of each of the three underlying commodities. As you can see, I think we briefly discussed how those are traded on Chicago and how they converted into metric tons, which we trade on SAFEX. So, just briefly going through there, I don't think I'll run through every aspect, but sort of, just highlighting there, we obviously trading 100 tons of beans, whereas a contract on CBOT is roughly 136 tons. So a bit of a mismatch there, which is, again, comes down to the market making risk and mismatch that we have to do. You've got the meal. And again, short tons versus metric tons. So, Chicago's contract approximately 91 metric tons. And again, our contract being standardized 100 metric tons on SAFEX. And there you go, the contract on Chicago, 27 tons equivalent in metric. And we're trading 25 tons, giving us that just the net. Basically, touching on the Rand spot and forward points. Now, without going into too much detail there, it is a combination of what's happening on the spot market. I think we're all aware of what's happening on the Rand spot and the variance and volatility we have there. And then the forward points get added to that, to the specific contract dates. I'll go through an example now. I've just added what the Bloomberg and Reuters sort of rigs are on that one. So just running through a bean conversion, how we get to a SAFEX price that's quoted. So essentially there you've got your price. Example on the day when I did this, 997 was quoted on Chicago at the time, Rand 730, and the forward points that we were using, 11 cents to get us to a deck forward point of 741. That multiplied by the conversion factor there, you can see 36.743 is what we're using there, divided by 100, times by the exchange rate with the forward points, giving us that Rand price. Pretty much the same exercise in meal. Obviously, the conversion factor different there, and the underlying price different there as well. But getting us essentially back to a Rand price again on the meal, 100-ton contract, and that's a price per ton in Rand per metric ton. Oil, just essentially a different conversion factor again. Obviously, touching on the deck and NOV differences there, so slightly different forward points would be used to calculate a different expiry month. Essentially, the risks, and I think we've touched on those risks as a market maker. You've got essentially three bid-offer spreads that need to be crossed and knocking out your risk. You've got your Chicago bid-offer, which everyone's familiar with, your Rand bid-offer, and then obviously your Rand forward points. All of those trade in a bid-offer spread, and that's a risk that we need to take into account when putting the prices on the market. And that bid offer that we put up takes that into account. The other aspect as well is, often as what we found on the corn contract, we offered a lot more liquidity than what was actually showing on the underlying Chicago market. So, the contracts that are bid offered, you'll see is quite a lot more than sometimes is showing on Chicago. If you can have a look at that directly. And essentially the reason there as well, the liquidity is on their overnight session. And obviously not their main session. So, touching back, their main session is the liquid session. And you can look at, if you've got big size to do doing that. And then obviously the tonnage mismatch that we've discussed. And the settlement risk that was also touched on there. So we have to sit there and make sure that we get that averaging right if we're carrying in a large position into settlement. That is quite briefly just that. I mean, if there's any questions there, and I think one aspect that has been raised is the bid offer on the complex. And by all means, there are contact numbers. We're more than happy to bring them in. The reason why we have them slightly wider is not a lot of volume goes through. So having traded that, we don't necessarily pick it up as quickly. So if you give us a shout, we'll show you inside that bid offer we're currently showing, and it just helps us be able to hedge out our risk a lot quicker.
Thank you very much, Wesley. Any further questions here in the auditorium? I think that's a fantastic offer on the table. If you're looking at size, please, give them a shot, and they'll be able to give you a price depending on the liquidity in the underlying market again.
Agreed. Yeah. So especially the overnight market being a lot more liquid. If a lot of size needs to be done, we can look into doing that overnight. Yeah. But again, as Chris said, we need to just we've got that risk, settlement risk, over the next morning.
Any questions from the webinar?
There's one question from the webinar. Are there any fundamental opportunities in trading the soybean spreads?
Fundamental. Look, we provide a price. At the end of the day, the underlying market is able to hedge themselves using this contract, and each market participant needs to know what their trade is, why they're getting involved. And the answer is yes, fundamentally there are opportunities there, but it depends on what your underlying use of the market is.
That's the joy of a webinar. You always like to say, could you clarify your question? But I don't know if they could always type that quick enough. But thank you very much for that question. If there's none other from the floor, I think we'd just like to move over and thank you very much, Dave, in Chicago. Are you still there?
You're welcome. Yep, thanks very much. My pleasure.
Thank you again. And, yeah, we wish you a very good Monday ahead of you. Thank you.
Thanks. Great.
On our side, thank you very much, Wesley. Certainly much appreciated. To our marketing team at the JSE who have set this up. Thanks very much for that. Rizma, you can take that back to everyone else. And certainly for the technology guys to make this webinar possible. We certainly appreciate that. Thank you. This has been our second one. I'm sure we can do a lot more. Everyone else who's been attending on the webinar, thank you very much. We've given you value for money. That's nearly an hour and 15 minutes of hopefully some entertainment. Thank you very much for the audience that made the effort of traveling through to Sandton. We appreciate that. And yeah, all the very best. We hope to see some business on the screens. Thank you.